Business combinations, from acquisition to consolidation mastery. Today we're decoding IND AS 103, business combinations, one of the most critical and interview-tested standards in accounting and finance. By the end, you'll understand how mergers and acquisitions are recognized, measured, and reported, and how to walk through the acquisition method confidently in any interview. Let's start from the basics. Acquisition method, goodwill, non-controlling interest, real-world cases. 1. Objective and scope. Why this standard exists. IND AS 103 tells companies how to record the purchase of a business. The aim is clarity. It makes M&A accounting consistent and comparable. Treat the transaction as buying a business, not only assets. How to decide scope? Ask, does control transfer over an integrated set of activities and assets that can generate returns? If yes, IND AS 103 applies. If the deal is between entities under the same ultimate owner, that is, a common control transaction, this standard is excluded. Those are handled with different guidance. Tiny example, if Company A buys a factory building plus machine tools only, it's usually an asset purchase. But if A buys the factory plus the workforce, customer contracts, and operating processes, it's a business combination. Common interview trap. Don't say all purchases are business combinations. Say instead, only transfers that include inputs, processes, and outputs with control qualify. 2. Key definitions. Short, precise definitions to memorize. Business. An integrated set of activities and assets that can produce goods or services and generate returns. Think inputs, people, materials, processes, manufacturing, distribution, and outputs, sales, contracts. Acquirer, the entity that obtains control of the other party. This is the buyer for accounting purposes. Acquiree, the entity being acquired, the business transferred. Control, the power to govern financial and operating policies of an entity to obtain benefits, usually shown by majority voting rights, board composition, or contractual power. Interview hint. If given a fact pattern, walk through each definition. Show the interviewer you applied the textbook definitions to the facts. End. 3. Identifying a business combination. Follow a short checklist. Checklist. Inputs, processes, outputs, transfer of control. If yes to all, it's a business combination. If not, treat as asset acquisition. Why this matters. Classification changes the whole accounting model. Measurement, disclosure, and future impairment testing differ. Mini example. Buying a brand name and customers likely qualifies as a business. Buying raw land does not. Say this clearly in interviews. Common pitfall. Relying on labels in contracts. Instead, analyze substance over form. 4. The acquisition method, core principle. Remember the 4-step backbone. Repeat it every time. Steps. 1. Identify the acquirer. 2. Determine acquisition date. 3. Recognize and measure identifiable assets and liabilities at fair value. 4. Recognize goodwill or a bargain purchase gain. Why follow it exactly? Deviation changes reported equity and profit. The acquisition method ensures the acquired business is reflected as if the acquirer bought it on the acquisition date. Interview technique. State the 4 steps first, then apply them to the question. This keeps your answers structured and persuasive. 5. Step 1. Identify the acquirer. How to identify the acquirer. Look for who obtains control. Use indicators, voting rights, ability to appoint majority of directors, or contractual rights to direct key policies. Consider practical ability to control, not legal form alone. Reverse acquisition flag. If the smaller legal entity controls the larger listed shell after a share exchange, accounting may treat the smaller as the acquirer. This is called a reverse acquisition. Explain the logic. Control drives accounting. Example to say in an interview. Even if Company X legally issues shares to Company Y, if Y's managers control policy, Y is the accounting acquirer. Step 2. Determine the acquisition date. What the acquisition date is? It is the date when the acquirer obtains control, usually the closing date, but it can be earlier or later if control passes at another time. Why the exact date matters. All fair value measurements and recognition happen as of that date. Subsequent events after that date are separate. Interview line to use. Fair values are measured as of the acquisition date, not the signing or reporting date, unless control also passed then. End. Step 3. Recognize identifiable assets and liabilities. Which items to identify? Record all assets and liabilities that are separable or arise from contractual or legal rights. Include tangible assets, liabilities, and identifiable intangibles like customer contracts, brands, and technology. Measurement rule. Measure each identified asset and liability at its fair value at the acquisition date. Fair value is the price to transfer an asset or settle a liability between market participants. Key point on intangibles. Recognize intangibles separately from goodwill when they are identifiable. That improves transparency and possible amortization or impairment analysis. Mini example. Customer list fair valued at the acquisition date is booked separately from goodwill. Pitfall. Forgetting contingent liabilities or legal claims. These must be recognized if identifiable and measurable at fair value. Step 4. Recognize goodwill or bargain purchase core formula. Goodwill equals consideration transferred plus non-controlling interest plus fair value of any previously held interest minus net identifiable assets at fair value. What goodwill represents? It is the future economic benefits from assets that cannot be individually identified and recognized. Think reputation, assembled workhorse, and synergies. Bargain purchase, negative goodwill. If net identifiable assets exceed the consideration plus NCI and prior interest, the acquirer has a bargain purchase. Recognize the gain immediately in profit or loss. This is rare and often requires rechecking measurements. Interview tip. Write the formula clearly, then walk through each component with numbers. 9. Measurement of consideration transferred. Elements that form consideration, cash paid, shares issued, and contingent consideration such as earnouts. Also include liabilities assumed that represent the price. Contingent consideration rules. At acquisition date, record it at fair value. Later changes depend on classification. If classified as a liability, changes affect profit or loss. If equity, changes do not go through profit or loss. Tiny example. An earnout that pays 50 crore rupees if revenue hits a milestone is a contingent consideration. Measure its fair value at acquisition and record it accordingly. Common interviewer question. How do you value shares issued as part of consideration? Answer. At their fair value on the acquisition date. 10. Non-controlling interest. What NCI is? The portion of equity in the acquiree not attributable to the acquirer. It represents minority owner's claim. Measurement choices. Option 1. Measure NCI at fair value of minority interest. This gives full goodwill. Goodwill attributable to both acquirer and NCI. Option 2. Measure NCI at the NCI's proportionate share of net identifiable assets. This gives partial goodwill. Effect on financials. Full goodwill increases recognized goodwill and total consideration. partial goodwill results in a lower reported goodwill figure. Both methods are acceptable under IND AS 103. Interview tactic. State both options, then explain consequences for reported goodwill and earnings. Step acquisitions. When control is gained in stages. What to do when control increases in stages. Remeasure the previously held equity interest to fair value on the date control is obtained. Record the resulting gain or loss in profit or loss. Then proceed to consolidate using the acquisition method. Why remeasurement? Because the acquirer's prior holding is converted into part of a business combination. Fair value remeasurement aligns accounting with current market prices. Example to say, if you held 40% at cost and then paid to reach 60%, remeasure the 40% to fair value on the control date and book the P&L impact. Pitfall. Treating step acquisitions as simple investments instead of remeasurement. That misses a potentially material gain or loss. 12. Reverse acquisitions. Short definition again. A reverse acquisition occurs when the legal acquirer is not the accounting acquirer. Control is the deciding factor. Practical occurrences. Common with share-for-share swaps, and when private companies acquire listed shells to go public. The accounting acquirer is the entity whose owners obtain control. Interview strategy. Explain with a concrete flow who controls post-transaction. That entity is the acquirer for accounting purposes. 13. Contingent consideration recap and classification. Contingent consideration are future payments dependent on specific events. Classify them as liability or equity at acquisition. Initial and subsequent measurement. At acquisition, measure at fair value. Later changes. Liability type changes go to profit and loss. Equity type changes remain in equity. Practical note. Document the drivers. Revenue, EBITDA, earnings before interest, taxes, depreciation, and amortization. User growth, and use reasonable scenarios to estimate probabilities. Example, an earnout payable if EBITDA exceeds a target in year 1 is a contingent liability. Remeasure on each reporting date if classified as liability. 14. Measurement period adjustments. What the measurement period is. A window of up to 12 months after the acquisition date to adjust provisional amounts. These adjustments are for additional information about facts and circumstances that existed at the acquisition date. Limits and rules. Do not adjust for events that arose after acquisition date. After 12 months, treat new information as a separate post-acquisition event. Or correct prior period errors if applicable. Interview memory aid. Measurement period equals 12 months. Yes, 12 months. Say it confidently. 15. Goodwill accounting post-acquisition. How goodwill is treated after recognition. Goodwill is an intangible asset. It is not amortized. Instead, test it annually for impairment or when indicators exist. Impairment testing basics. Compare carrying amount of cash-generating unit to its recoverable amount. If recoverable amount is lower, record an impairment charge. Why no amortization? Because goodwill does not have a reliably determinable, useful life. Therefore, impairment testing better reflects value decline. Interview follow-up. Be ready to explain cash-generating unit allocation and the practical steps of impairment testing. 16. Bargain purchase negative goodwill. When it happens, if fair value of net assets exceeds the purchase consideration and other items, you have a bargain purchase. Accounting treatment. Recognize the excess immediately in profit or loss as a gain. Then double-check valuations and measurements. It is rare and often signals measurement errors or distressed buys. Interview safety line. If I find negative goodwill, I recheck all fair values. Confirm identifiable liabilities are complete. Then recognize the gain. 17. Common control transactions. Why IND AS 103 excludes them. Common control transactions do not change ultimate control. The economic substance is continuity of ownership, so acquisition accounting is not appropriate. Accounting alternative. These are typically accounted for using pooling or predecessor values under local guidance, often described in Appendix C or other standards. Interview nuance. If asked why the acquisition method is wrong here, say, there is no change in control, so purchase accounting would distort historical performance. 18. Disclosures required. What to disclose, concise list to recite. Required disclosures include the name and description of the acquiree, acquisition date, percentage of voting equity interests acquired, primary reasons for the combination, details of consideration transferred, recognized goodwill or gain, NCI amount and measurement method, and the impact on revenue and profit. Why disclosures matter. They let users of financial statements understand the deal's economics, future obligations, and how numbers were derived. Transparency reduces information asymmetry. Interview trick. Mention at least 3 disclosure items and why each helps investors. That shows depth. 19. Impact on financial statements. Immediate balance sheet effects. Assets and liabilities of the acquiree are reported at fair value. Goodwill is added as an intangible asset. NCI appears in equity. Ongoing effects. Future profitability ratios, return on capital employed, ROCE, and earnings per share, EPS, can be affected by additional goodwill and by amortization of recognized intangibles. Contingent consideration remeasurements can cause profit volatility. Practical interview line. Point out how analysts adjust post-acquisition figures for comparability and pro forma analysis. Real-world examples, worked example, numbers to state and walk through. Scenario. Company A buys Company B for 500 crore. Company D's net identifiable assets at fair value equal 400 crore. No NCI for simplicity. Goodwill equals 500 crore minus 400 crore equals 100 crore. Report assets and liabilities at fair value. Book goodwill at 100 crore. Share swap example. If A issues shares as consideration, measure the shares issued at fair value on the acquisition date and include that in consideration transferred. Interview tip. Use round numbers, state each step, and show the arithmetic. Interviewers like seeing the process, not just the answer. End. 21. Common mistakes and interview traps. List of frequent slip-ups and how to avoid them. Mistake 1. Calling any asset transfer a business combination. Fix. Check inputs, processes, outputs, and control. Mistake 2. Ignoring contingent consideration or measuring it incorrectly. Fix. Classify at acquisition and remeasure correctly. Mistake 3. Failing to decide how to measure NCI. Fix. State your chosen method and explain the impact. Mistake 4. Not remeasuring previously held interest in step acquisitions. Fix. Remeasure to fair value at the control date and recognize gain or loss. Interview strategy. When you answer, close with, I would check X and Y to show structured thinking and risk awareness. Quick revision summary. 4-step engine. Identify the acquirer. Fix acquisition date. Measure assets and liabilities at fair value. Compute goodwill or bargain purchase. Decisions that matter. How you measure NCI. Treatment of contingent consideration. And whether prior holdings are remeasured. Practical takeaway. Always show the 4 steps first. Then walk the interviewer through a short numeric example. That combination of structure and numbers wins interviews. Closing recap. IND AS 103 is rule-based but driven by economic substance, control, and fair value. In interviews, lead with the 4 acquisition steps, then cover measurement of consideration, NCI choice, and Goodwill logic. Practice a short numerical example aloud and always explain your assumptions.